Okay, Anna, so we've been teeing this up for a little bit. Today's the fun day out of the cycle because all the other days are crappy. Today's the day we get to talk about investing.
Yep, the most exciting of the topics.
But you can't do investing. You can't invest unless you have everything else laid out correctly first, right?
No,
At the end
just
of the
ignore
day,
this if you haven't started with the first one.
Yeah, go back to episode 1. So today, 3 buckets for your investing. We call it foundation, bridge, engine. You can call it whatever you want. Bucket 1, bucket 2, bucket 3. Get out your piece of paper, get out your note card, There you go. 3 buckets, 3 columns, whatever you want to do. Let's talk about each one of these. Give us the layout of the first bucket, if you will.
Okay, bucket number 1 is your foundation. We already went through this with the emergency fund, essentially emergency fund or any other expenses that you have coming up in the next 1 to 2 years, I would say.
And the whole purpose of your building out this emergency fund is it acts as a buffer against the volatility of the third bucket, your growth engine bucket, right? It's at the end of the day, you can't be all equities. You can't have all your money in stock and be okay with a 20 or 30% pullback if you don't have the supporting cast, as it were, the supporting cast of cash that give you the opportunity to still spend and live your life. That's the whole purpose of building out that foundational cash piece first.
Yep. Next part, bridge. The bridge is the middle piece where you might have some goals that you know about, like you need to buy a car, but it's still 2 years out. You just know it's coming at some point. Or even the house, anything that could be coming down the line. You want to get new windows, anything that's like a big purchase.
So fun.
So much fun. I just know windows cost a lot.
Honestly, I've thought about that. I'm like, we could stand to get some new windows around here. Tell me you're middle aged without telling me you're middle aged when you get all excited for new windows.
New windows.
And the other thing, this kind of lines up with some of our other thinking as it relates to other intermediate term goals, let's say, like for example, in 529 plans, and maybe we'll talk about college funding at some point in time, but in 529 plans, what we suggest is in your freshman year of high school, you take your freshman year of college 529 money and move it to something safe and secure, the money market fund, the bond fund, the treasuries, whatever is, just there, because it takes away that sequence of returns risk, the risk that the market's going to go down the day before you actually need the money. And so you're taking away some growth opportunities, but you're also locking in your goal attainment. And at the end of the day, the only thing we care about is getting to your goal, like
it's not worth risking it by keeping it invested up until the day that you need it, because you never know where the market is going to be at that point. And you don't want to be worrying about that on a day-to-day basis.
And at the end of the day, if the goal is flexible, if you're like, hey, at some time in the future, I'm going to need a new car, or, we really want to buy a lake house, but we don't have the time frame, well, then fine, keep it invested long term. But as soon as you start locking in some time frames, when we build out retirement or cash flow plans for clients, sometimes they'll say, hey, every 7 years, historically, we've bought a new car for the family. Like, put that in the plan. Well, we can. That's totally fine, because the time frame, that money's not going to be in your emerging market value fund. It's got to be in something that's a little bit more secure, because we've got a known goal and a known time frame. So once it kind of breaches that 5-year number, let's get it something safe and secure. Doesn't have to be cash, can be short-term fixed income, can be treasuries. There's lots of different options there. And then our last bucket,
the engine. What drives
vroom, vroom.
all your growth, where your long-term goals are invested in. So typically going to be in a diversified portfolio. So hopefully not as volatile as just like the regular market or individual stocks. Like, we are still diversified, but this is where you're going to get primarily your growth from. This is where you're getting your retirement assets, or even if you're in retirement, just your longer term retirement assets. When you're retired, you might be retired for 30, 40 years. So we need to still have a lot in the engine bucket so that it can sustain you for that long period of time.
as we're just kind of piecing this out, do you think that we need 2 years of cash, 5 years of treasuries? Are we building this kind of sequentially? If I'm just getting started, am I building up all of my cash first, then building up 5 more years, then building up everything else? How do we think about that?
This isn't really expense based. This is more so goal based. So we want, if you're working, we already talked about the emergency fund. You should at this point know what that multiplier is, what that number is going to be. So that's what it's in that first foundation cash bucket. That middle term bucket is only there for those shorter term goals. It's not necessarily there to fund any sort of expenses for 5 years. It's just for any goals that fit into that bucket. So when we're tying this back to the homework piece of this, where we have these different columns or these different buckets, whatever you want to look at it, the lens through, it's not necessarily that we're asking you to put your assets into each category. Yes, that's part of it. So know how much cash you have in figuring out that emergency fund, know what you have in that short bridge bucket, and know what you have in that longer term engine bucket. But it's also tying the goals to those. So how far out are we from that car purchased or the house purchase or the window purchase, as Josh and I are getting new windows, and knowing where you stand generally with retirement. Are we 7 years out from there plus? Then all those assets should be in the engine bucket. So it's not just figuring out what assets go into each category, but also where those goals land for you and updating that as you see fit so that those goals are, the assets are being tied to where those goals are.
Ultimately, in what we've talked about here is when you tie your money to a specific outcome or tie your money to a specific goal, it becomes a lot easier to see where it's supposed to be. And it's a lot easier to tolerate whatever is going to happen. You know, if you're looking at your retirement account and you're like, I'm 40 and retirement's 20 years away, and it goes up and down, percentage points a week because of, whatever's happening politically or globally or whatever, that's a way easier, thing to stomach than if your kid goes to college in August and it's still in stock and it's going down 2 or 3, 4, 7% for the quarter. And you're like, oh crap, I gotta write this check. The time to have that money safe and secure was 5 years ago. And you take a little bit of growth off the table potentially, but you're gaining the goal attainment piece because you go, this is when I need to write the check. It's August of 2026. I absolutely need to have 15 grand in the 529 ready to write a check for that semester's tuition. So I think this is a great way to think about this goals-based investment planning. We created a scorecard for this. You can score yourself on this plus a bunch of other different categories. Get your score immediately. It's stackingbenjamins.com/scorecard. You get your number and then some feedback about that. And then the other thing that I wanted to send out to everybody is, so we have 2 more of these coming that we are done with this season, and then we go to our 1-week break. Anna and I are building out we're building out the next 8 weeks. How's that? Trying to figure out what you guys want to talk about. So I have an idea of what we should talk about, but I want to hear from listeners what's kind of top of mind for everybody. So if you want to vote, if you want to tell us what you want us to cover in these segments in the next season, send me an email. It's og@stackingbenjamins.com. Just, hey, cover this, cover this, cover this, cover this. We're going to compile all of it. We'll try to put it together in 2 weeks. We're going to start writing those shows in probably 2-ish weeks from now. So over the next couple of weeks, if it's interesting to you to vote on what you want us to cover, just send me an email, og@stackingbenjamins.com. Okay, Anna, adios.